The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box Europe. I'm Steve Sedgwick with Karen Cho and Juliana Tattelbaum, and these are your headlines. US President Donald Trump touting Saudi investment worth hundreds of billions of dollars as his Middle East tour continues, with the US Agriculture Secretary telling this very channel the world will benefit under Trump 2.0.
And that's what Donald Trump is doing, and he is using his best skills of negotiation to bring countries to the table like Saudi Arabia and their resources as we go back to reshoring what we've lost over decades in America.
German shipping giant Hapag-Lloyd backs its full-year guidance despite flagging considerable uncertainty ahead. We'll talk through the outlook with the CEO, Rolf Haben Janssen, at 9:30 London time.
And German defense group Renk doubles its quarterly order intake, raking in 550 million euros. We'll talk to the CEO, Alexander Segel, in an exclusive interview at 8:30 London time.
Right, a very good morning to you all. Lots going on in the world, lots of exciting data we need to pour over, including the US inflation data from yesterday. But I think we'll go straight into top stories. We've got a very, very exciting guest we want to get to in a couple of minutes' time.
Well, let's get right to it. The top story out of the Middle East, U.S. President Donald Trump hailed Saudi Arabia's leadership after the White House announced a commitment by the kingdom to invest $600 billion into the U.S. in a series of agreements, including an almost $142 billion defense sales deal. Trump signed a series of bilateral agreements with Saudi Crown Prince Mohammed bin Salman in Riyadh before addressing the U.S.-Saudi Investment Forum yesterday. A slew of top U.S. business leaders, including Tesla CEO Elon Musk, OpenAI's Sam Altman, and NVIDIA CEO Jensen Huang, attended, while NVIDIA announced it will sell a first tranche of 18,000 of its latest AI chips to Saudi startup Humane, launched by the PIF.
There's still a lot of trade news as we wash up from the weekend conversations between the Americans and the Chinese, but the reality is sector-specific is what the market is focused on this week around those technology curbs, and the Trump administration reportedly plans to rewrite some of the Biden-era AI chip curbs that had drawn strong criticism from technology companies and foreign governments. That's according to Bloomberg. Trump is set to rescind what is known as the AI diffusion rule. You may recall this created 3 different levels of access, and the administration is now drafting new rules that will focus on direct negotiations with nations.
Okay, traders are pricing in nearly 50 basis points of cuts from the Bank of England by the end of the year after Tuesday's jobs figures showed a third consecutive month of slowdown. The really interesting data, I think, was on the average weekly earnings in the private sector as well, just coming down nicely, as indeed, to be fair, the MPC has called. The data comes after the Bank of England cut rates by 25 basis points last Thursday in its first decision after President Trump launched his trade war. Now, that move was anticipated by markets, but what they didn't anticipate was the intriguing 3-way split amongst members of the MPC, the Monetary Policy Committee. The 2 voting for a steeper cut we saw was Mr. Taylor and indeed Swati Dhingra. The majority, 5, going for 25 basis points, and 2 voting to hold. Well, Morgan Stanley called the vote split more hawkish than expected and removed a June cut from its forecast. Goldman did the same, but said a weaker economy will push the MPC into faster rate cuts in the second half of the year. Well, I've said this to her before, and I think other people have echoed my sentiments, but I believe that Catherine Mann is one of the most interesting members of the MPC. She's one of 2 members of the MPC who voted to hold rates. Catherine Mann is an external member of the MPC at the Bank of England, joins us now. Catherine, I think you're a very, very interesting and learned woman as well in many. But I think you're most interesting because people find you... Your calls are well flagged in many ways. You called in November what you were potentially going to do in February, but then you held this time round and you went 50 in February, so you went big, which is way bigger than some people had expected. Yeah. But But you call it as you see it rather than as the market thinks you should see it as well. And I think it'd be very interesting just to, before we talk about the current situation, the unpredictability of the moment, just go back over that February decision and indeed your decision last week as well, because I think a lot of people really want to know what's in the mindset of Catherine Mann.
Okay, thank you very much for having me. So there are three pillars of any decision. One is to look at activity in detail, one is to look at inflation in detail, and one is to look at where the market conditions are. And I think that when I looked at February's conditions, I thought that there would be a nonlinear change in the labor market that would be deleterious for growth and consumption, and that would lead to pricing power, reduction of pricing power of firms. And so that cascade from a very weak labor market into lower inflation was what I saw in the cards, and I thought that a 50 basis point cut in February was appropriate given those expectations, my expectations for market conditions. So where are we now, or where was I in the last decision? The first observation is that the labor market has been more resilient. Now, yes, we've had some prints that are indicative of a slowing labor market, but it is not a nonlinear adjustment. Number two, and actually much more important, are household expectations have in fact increased, both at the 1 year mark and the 5 year mark. I worry about that. Plus, goods price inflation has increased. PMIs for input and output prices has increased. And so that cascade from labor market weakness to pricing weakness did not happen. And then finally, the market's given me 75 basis points. I only asked for 50.
It's giving you the leeway you wanted as well.
So it's a hold.
Catherine, I thoroughly, my boss, as I said to you off air, but I might as well tell the viewers, my boss gave me the opportunity not to go to the lock-in for 2 hours last week. I said, no, I learned so much from sitting there and reading your 96-page MPR, your Monetary Policy Report. It's precious time. No phones, no gadgets, no outside world, and I love it. Locked into the bowels of the Bank of England. And one section that I got to, which I found fascinating, and I know that my colleagues will ask you about international affairs as well, but I found the agents section always really interesting. The Bank of England agents, they go out into the country, they just basically tell the Monetary Policy Committee what they're seeing. Yeah. I read that the agents see a pretty gloomy picture out there, and I was wondering why that didn't influence your decision to go for 25.
So we go with the agents. They go around and set up, but we also go around the country and not only talk to the business community, but also to citizens as part of the citizens panels. The agents have been painting a lack of a robust environment for a while, and that's an important signal. And in fact, we find that the agents have been a forward-looking signal. However, until we see something in the until I see something in the inflation data that is persistent.
But Catherine, to jump in, you do see something in that the average weekly earnings figure we just seen was very encouraging. I think it was down to 5.6%. But and again, I'll probably mix up my numbers, but I'm pretty sure the MPC sees average weekly earnings, which is one of those two sticking points they were worried about, that and services sector inflation. You see that coming down to a 3 handle by the end of the year. That's pretty much a green light for more cuts, though, isn't it? If that was one of the two big things you were worried about.
Well, we put out a variety of things that we look at in detail. I look at a lot more things than that. And I'd have to say that right now, the labor market is a forward-looking, indicator. We look at DMP, the forward-looking wages, forward-looking pricing from the decision-maker panel. I need to see the loss of pricing power. I need to see that firms are starting to be much more moderate in setting their prices across a broad range of products. And as I said, the data that I've seen, goods prices inflation is actually going up.
Okay. Wow.
Not down.
That's a fascinating point, because front page of the FT today, the Chinese are taking issue with the US-UK trade agreement, worried that the Chinese are going to be squeezed out of the supply chain. Right. And one would have to think if that happens, then the pricing power is going to erode somewhat, because the American prices can by no means be cheaper than the Chinese, right?
So I think, there is, I will agree with my colleagues who believe, based on data, that there will be lower inflation on goods prices in the global economy. There will be some trade diversion that will lead to moderation of import prices in the UK. But there's a lot of margin between the dock and the shelf. And there are a lot of players in there who have had squeezed margins for an extended period of time, and they will look for an opportunity to rebuild those margins. So just because inflation is lower at the dock doesn't mean that we're going to see as much of a pass-through to lower inflation at the retail shelf. And that's where that margin in the middle, that margin in the domestic economy, is what I'm looking at as a very important indicator of whether or not we see the sort of the moderation that comes from all the trade stuff that's happening showing up at the retail level here in the UK.
Very fluid conditions you're highlighting here. The reality is that just this week we had movement on the massive agreement between the US and China, at least a row back from the embargo levels on tariffs. The decision you had to make, of course, somewhat preemptive before there was more progress on this discussion. Right. Did it make any difference? I know you were cautious anyway as you were sitting at that neutral handle, but were you a little bit surprised that the decision had come through so quickly to row back at least, and would it have made any difference if the news flow had been slated a bit earlier than the decision?
So there's a lot of news, but there's not a lot of detail. And ultimately, how firms react to news is to sort of hold things stable, as opposed to start to cut price right away or to move their supply chains. Or, I think we've read things like who's putting things on the boats versus not putting things on the boats. So it takes a while for news to translate into actual policy and actual numbers. And only at that point can firms really be reactive in a consistent way. We might see some little blips, as I say, boats did arrive or they didn't arrive, with things on them or things not on them. But ultimately, that may lead to some volatility in inflation, volatility in prices. But we have to look at something that is more consistent, more trend, in order to evaluate the stance for monetary policy.
Let me take you back to one of your recent votes. In the most recent meeting, you obviously voted to keep rates unchanged. But before that, you were in the camp of going for a jumbo rate cut. Can you help us understand how you think about a 25 basis point cut versus a 50 basis point cut?
That's a very important question, and I appreciate your asking it. My view on how to deal with the degree of volatility in financial markets, and there is quite a bit of volatility in financial markets across a range of asset classes, and a lot of that volatility is coming from cross-border spillovers. It's a global marketplace for financial assets, so of course, we're going to be the recipient of volatility that's coming from other places. But in that environment where there is so much volatility coming from other sources, it's important to make it clear what your stance is. And in my view, a 50 basis point change is a clearer signal that comes from me, I'm making the choice, a clearer signal for what I think the appropriate stance of monetary policy is in the UK for the UK. I think 25 basis points gets lost.
In terms of that note around signaling and the votes, what should we read into the vote split this time round? Because that was perhaps one of the most interesting features, that it was a three-way split, not a two-way split this time.
Right. Well, I think that, I'm not going to speak for my colleagues, but we all look at the information, but we do interpret, I think, things differently in terms of, is it most important what's happening in the labor market? Is it most important what's happening at the pricing power of firms? Is it most important to think about what's happening on the supply side? So we haven't talked about that, the degree to which you believe that productivity growth on the supply side will recover or will take some more time to recover. And so these are parts of other people's decisions, and we weight them differently.
I want to pick up on some of the volatility in financial markets because we were in Washington, D.C. last year having a great conversation around capital flows. And a lot of that really around what happened in the COVID era and how rapidly money moved out of some markets. But we've seen it too in this window around the US dollar. And it's been surprising just how rapidly dollar is king story has unwound. And of course, it's been bumpy around each different trade story. What is taking place here? Because Trump is so fixated on correcting the trade deficit. But is there something deeper happening around the reserve status of the dollar that he is now undermining with some of this trade volatility?
Well, I think the dollar is still king. You know, you look at it, and yes, exchange rates move up and down, but to sort of suggest that the dollar isn't king anymore is a little premature. I do think that there's a lot of reassessment in portfolios about the appropriate composition of dollar versus other based assets. That's if we're having big changes in exchange rates, even algorithmic trading would alter the composition of an asset portfolio. So this, you know, to some extent, what we're seeing is an algorithmic trading.
Catherine, I think we've got you for a bit longer. You're in a desperate hurry, are you? Oh, half and half, that one's okay. Well, we'll keep you for a bit longer because genuinely I could keep you for hours and chatting to you. So look, we spent a lot of time talking about the broader market and about Mr. Trump and about the world and about the 41 times plus that the NPR mentioned unpredictability or uncertainty. I want to go back to the UK because something that I picked up from talking to Andrew and now speaking to yourself and reading the report is that actually UK trade disruptions because of Trump account for 0.1% of GDP, 0.1%, whereas another 0.2 came from the global disruptions. So I want to go back to the real key factors for the UK, which is the UK itself. And we haven't talked at all. In fact, no one asked a question about Rachel Reeves in the presser, which I thought was fascinating. Rachel Reeves has done good old-fashioned Keynesianism. They're going to be borrowing a lot of money and raising a lot of tax to deliver enormous growth to the United Kingdom, potentially. And in the February NPR, when I spoke to the governor, it was hard to see when and where the growth from all those initiatives comes into your 3-year chart. Have you got any update for us that you actually are beginning to see further down the line potentially the benefits of that? Because at the moment there are concerns that the increase in NIC is detrimental to the economy. The increase in taxation is detrimental eventually to the amount of money the government has to spend on other things. So is the growth, any sign of it coming through?
Well, of course, we take announced fiscal policy incorporated into our forecasts, and we have incorporated as you say, the Keynesian part, which was the expenditures that were distributed around the entire country, primarily through the health sector. That was very clear in November, coming through into our initial forecast. One of the things that I saw in November, I was very positive about that Keynesian sort of priming type of approach. But what we have observed is that pretty much most of that has been saved, which is not consistent with sort of past behavior of UK. I'm not British, but I'm American. We're
yes, of course.
Anglo-Saxon that way, and we tend to spend in the past. But these days, people have been much more concerned about volatility in their paycheck, how far it's going to go, whether or not they have to remortgage. These sorts of savings buffers have been very important. So the Keynesian aspect in the forecast, but has been essentially moderated by savings buffers by consumers. Now, what's also in the forecast is on the supply side, the role of planning and affecting housing, and infrastructure and the supply side of the economy. So we do incorporate those things into our forecast, and those do start to look, they're part of the supply side growth assumptions that are embodied in the forecast itself.
Brilliant. We'll let you go because I got the hint. We can't keep you forever. But how extraordinary a world we live in. Not only with Mr. Trump's oscillation on a daily basis, but the world where the Germans are beginning to spend money and the British are beginning to save. What on earth is going on in this world? Catherine, lovely to see you. Thank you for joining Karen, Juliana and myself. Catherine Mann, external member of the Monetary Policy Committee at the Bank of England.
Now, the U.S. is looking to expand its trade deal with the U.K. to include exports of pork, poultry, rice, and seafood after beef and bioethanol producers were granted expanded access to the U.K. market. U.S. Secretary of Agriculture Brooke Rollins said the sectors are at the front of the line and that U.S. exporters are willing to adjust their practices to meet British standards. Tanya asked Secretary Rollins when the first deliveries could be expected.
Hopefully within a matter of weeks, if not months, we'll begin to see that shipment. And by the way, it goes both ways. It's not just bringing in the beef from the U.S., which of course I believe is the best beef in the world, but also there's incredible beef cattle that are raised here in the U.K. and moving that product into the U.S. again as we firm up what has been a 240-ish year partnership to bring real peace and real prosperity to the world. And that's, I can't understate, I think, how important last Thursday was in achieving that goal.
Of course, there have been concerns about US hormone-treated beef and chlorinated chicken. It's not part of the agreement. It's prohibited here in the UK. What can you say, though, to reassure UK consumers and the farmers here that they will get safe beef and chicken?
Well, I really appreciate you asking that, and I have been very clear. I think there is a narrative here pushed forward by a lot of members of the press that just isn't accurate. First of all, the chlorine chicken, that I think the latest number from the U.S. is that only affects about 5% of our poultry industry. And even that 5% is getting less and less by the day. So I think there have been moves within the industry to really move away from, not that there's anything unsafe about that necessarily, but there are better, perhaps friendlier products that we have begun to use in the U.S. over the last number of years. And so that only affects the chlorine-infected chicken, however they say it, is only about 5% of our current population. On the beef side, America has some of the most stringent, most effective regulatory processes in place. And so from the hormone-treated beef, would say very proudly and loudly that that beef is the best in the world, and that the rest of the world is beginning to catch up, that it doesn't mean it's bad or unhealthy or anything. There's no science that backs any of that up. But there's also a great lane of organic beef, quote, that is coming from America too. So all of the above brings such great choice to the European, to the English consumer on the beef and on the chicken side as we expand, hopefully, those markets into seafood and pork.
Coming up on the show, losses mount at Burberry as the British fashion house flags macro uncertainty. We'll be joined by Charlotte with all the details next. Plus, Donald Trump continues his tour of the Middle East after agreeing a raft of deals with Saudi Arabia. Dan will join us with the latest in around 15 minutes time. And Annetta will be speaking to the CEO of Renk as order intake surges more than 160% in the first quarter. Don't miss that interview coming up at 8:30 London time.
Full-year profit at Burberry beat expectations, with the group saying brand sentiment is improving. The luxury giant warned the macroeconomic environment has become uncertain in light of geopolitical developments. No news to anyone out there, I don't think. Charlotte, this is a brand. It was hoping to build on the success it had with the reset, the timeless British luxury. But of course, trade tariffs, uncertainty, very much on the same landscape. So how did you think it looked in terms of self-help versus these macro trends?
Yeah, especially when the US was meant to be the growth market this year, and especially for Burberry, always identified that they have under-penetrated that market. That's where they could see most growth opportunity to kind of move away a little bit from China, where they make about a third of their sales. But look, it looks like we are having the first signs of a turnaround at the brand there. Suddenly they said significant improvement that they saw in the second half compared to the first half. They say retail comparable sales down 12% overall for the year, but that was down 5% the second half against down 20% in the first half. That's really that trend that will be reassuring for a lot of investors. Of course, you remember that they brought in a new CEO in the last summer, Joshua Schulman, who came from Michael Kors in particular, and coach and try to work around that brand and improve the visibility of the brand, desirability of the brand as well, because they have been suffering from this. So again, there's a lot of certainty out there, but they are seeing things coming into play there. So just operating profit at £26 million there. And you remember back in Q3, they actually upgraded the guidance for this year, saying they are seeing an improvement there. They're cutting, they presented that plan back in November, that's called Burberry Forward, in kind of laying out the strategy of the new management, cutting the exposure to outlet. They said they're continuing to work on that, on inventory overhang and resource scarcity. So looking at cost cuts, they had previously announced a £40 million cost cut program, and they're announcing this morning an extra 60 million of savings by full year 2027, which means the total amount of savings will be 100 million by full year of 27. That will include 1,700 job cuts globally in that period. But overall, here again, they said it's early days in their turnaround strategy, but they are seeing some positive responses there. And again, they're very much focused on outerwear. They know this is where they have most pricing power, in particular scarves and the trenches, and they said this is where they want to build on as well.
I'm somewhat amused because that whole slogan, it's always Burberry weather for outerwear. I mean, it's been really hot. It's almost too hot for a Mac jacket, trench coat, too hot for a Burberry scarf in the last couple of weeks. So I wonder whether they're going to get a bit sabotaged by the weather in the UK recently. And the other point is there's another outerwear jacket in the room, and that is Moncler, because there's been still a lot of talk in the background that Moncler could be a potential contender to try and acquire the business. Is that still kicking around in circles, or is Burberry out of the woods now?
Not so much. Yes, at the time that rumor did start to surface, and some people said, well, it could make sense because they're two outerwear champions, so maybe they could work together. But it looks like that has been completely dispelled for now. But they said they will be ramping up the frequency and the reach of their campaigns going forward because of the positive reception that they've had of their campaign so far. And look, a lot of analysts think that the turnaround might be happening. And again, we had Citi upgrading Burberry just a couple of weeks ago. They had them on neutral since the financial crisis, since 2008, but they say they actually see the pieces in place for the turnaround. And looking at the shares, of course, remember that Burberry is out of the FTSE now because of the poor performance that they've had recently, but they're up 13% over the past 6 months against LVMH, that is down 6.5%. And Kering, the other turnaround story, we know they're working on Gucci, they're down 10%. So they've had a boost over the past couple of days, a potential deal between the US and China, obviously positive for all of them.
Right.
But Burberry is standing out as a potential positive story within the luxury group.
Well, that's exactly where I wanted to go with you next, that luxury is often traded like a proxy for China, and we've seen it do just that in the last several weeks. So what have analysts and investors been saying in the last few days since we've had the retreat on tariffs from between the US and China? Has luxury changed in terms of position within portfolios?
Well, certainly they are watching carefully, can this potential deal with the US be a positive for the sector? Can they allow a stabilization for the luxury environment? Again, we've seen all those luxury stocks higher over the past couple of days. Now, we've seen for Burberry in itself, if you can see, it has stabilized over the past couple of quarters, still down 9%, so things are still tough, but certainly much better than what we've seen in the second half. So extra positive news for a potential deal is extra positive news for the sector.